Welcome to the Mortgage Heroes Weekly Podcast. I'm Andy Cruz here in Business Development.
And I'm Brian Landeros, a.k.a. Brian Lends Money on Instagram.
And I'm Will Flores with Mortgage Heroes, your VA loan specialist.
Well, welcome back to a new show, guys. We have a very interesting topic to review today. Here's the topic. Home equity declines $2.3 trillion shortly after reaching all-time historic highs, but there are some facts you need to know. I had prompted you that we were going to talk about this, but we got to go over the facts first really quickly. So this is from a Redfin report that was echoed by Bloomberg and Forbes and all these other financial online outlets. As of June 2022, it was estimated that home value total, all homes in the United States, were valued at $47.7 trillion. By the end of 2022, home value was down to $45.3 trillion. So that's where we get this 2.3, roughly 2.4 trillion of decline. But even though home prices are reported to be up over the last 12 months, the median price has fallen 11.5%. High density areas seem to be most hard hit, most notably New York, San Francisco, those of the like. So the key point here, though, is right before we get into our conversation, the measurement of a house value in total was up by 13 trillion since 2020. So what we really have happening is it's still up 13 trillion.
Yeah.
So what we had happen was like a rise of 15 trillion and a decline or a retreatment of about 2.3, 2.4 trillion. What the heck is going on? Why is this happening? And what should people do? Let's talk about it.
Whoa.
So right off the bat, I did want to highlight, like you spoke about some of the markets that are being hit the hardest.
Yeah.
And I saw a report. San Francisco is 14% down. Seattle's 13% down. San Diego's 10% down. And both Phoenix and Denver are tied with 8% already in loss of prices. So that's already something that we're starting to see. And one of the things I feel that's happening is that we're starting to see all the economic information that happened in 2020 already starting to crash here in 2023. And what I mean by that is that, with unemployment on the rise, with the job losses only expected to go higher, I feel like this is, influencing the market for sellers to bring the price down because of the fact that, there's not as much money left for borrowers to be able to squeeze out when it comes to their approval. So by default, I feel like they have to lower prices down.
So you think there's just going to be an even more easing to come?
I think before we see an easing, it's going to get a little bit worse. But I expect it to come down as the months progress because I feel that with jobless claims going up and high tech companies, firing people and laying them off. What's going to happen is that eventually people are going to run out of money, savings, and we're already starting to see people deplete their savings at levels higher than ever before seen. Right.
This is the highest credit card debt we have,
and spending. Spending on the credit cards.
To that point. So what happens when people hit a point where they can't pay for certain bills, right? So they start generalizing what they need to pay first, what's more important to them, and little by little they give different importance to different bills. What I feel is going to happen is eventually your house is going to be the most important one, so by default that's going to be the last one to go out the window. So by that moment, I feel when we get to even more layoffs, there's going to be more reason and more motivation for sellers to have to sell their house, not because they want to profit, because they either need to survive to pay their bills, or they honestly are underwater and can't afford anything anymore, and their house is going to be a big payoff if this doesn't go any lower. If equity doesn't keep following the trend and come down.
Well, again, we have a ton of equity right there, right? And that was built when interest rates went so low. It gave affordability based on the current San Diegan income, right? It got people to qualify for homes easier. And so with rates being as low as they were, it was great. Everybody they had FOMO, right? For some of us don't know, which I know you don't know, the acronym for that. FOMO.
Fear of missing out.
Oh, there you go. He knows it. No, there's a lot of people that don't know that one, but the fear of missing out, right? They're going to go out there. They're going to go and try to just get more properties. Hey, if my brother got one or my cousin got one, how do they do it? I'm going to go get one.
Right.
The interest rates allowed for that. So because there was so much activity, the equity just kind of took off. So when I hear 2.3 trillion, 2.4 trillion in loss in equity, it's like, come on, guys. Those numbers were like they were exaggerated.
Yeah.
If you really look at the trend, equity's not supposed to build that fast.
Yeah. I mean, that's the highest equity measurement ever in recorded history.
Right.
So a little bit of a retreat from that, I think, is not surprising. But I think, I think it has everything to do with the Fed. I mean, it's obviously, I'm probably overstating that. But I mean, when you make money so inexpensive to borrow, it allows you to spend more on the total price you pay. Yeah. And I mean, how many times do we sit around and we're like, oh, this person was bidding $30,000 over list price or asking price. This person, then the next guy
what do
goes
you mean?
40.
You're being too nice, Sandy.
I'm going to get there. But it's like 50,000 in some cases.
100.
Like 100,000.
Yes.
But that's because, hey, I'm going to make a concession. The money's cheap. I'll stretch that far to make it happen.
I sold my property
but then when that's like the
San Francisco, right? And so I can do that. I'm going to buy another second home, or they're selling this one. Yeah. We're working from home. COVID changed a lot.
Totally.
It changed a lot.
It was like this effect of like the rising. It's that saying, the rising tides raise all ships. Yes. It's kind of like, this property goes up and the next one does, and then all of a sudden they're all going up at the same time. But also when the tide goes out, those ships start to decline. They start to sink a little bit too. Not sink. I shouldn't say that. The water retreats and the water line goes down. I think that's what we're seeing here. Yeah. But to Brian's point about unemployment, I think that puts a lot of pressure on prices.
Absolutely.
And there's not necessarily a direct correlation, because in between the unemployment numbers and people losing their homes is the person themselves.
Yeah.
Their savings, their retirement, and the ability to sell the house. When we were in mortgage real estate in, the early years of 7, 8, 9, 10, a lot of people were over leveraged and there was not as much equity. And when you sold, you were also selling at a waterline or at a loss or a short sale. We don't have a situation.
Yeah.
So I think that if people are getting in trouble with unemployment, they'll still be able to sell and they still have equity. Exactly. It doesn't solve their housing problem because they're going to have to move somewhere, but at least they're not going to be taking it in the shorts.
Yeah, and to your point, I feel like it was a bad combination when rates got dropped back in 2020, and then the Fed went and simulated the economy, giving people a bunch of money and amassed, huge, savings that now are being depleted, and we're starting to see things that they bought that can't be paid anymore, and that's all going to start leading into savings are being depleted. Credit card is up the roof. So it's like, what's going to happen next?
We're starting to see like car repossessions. I know we talked about that offline. And also I've heard this like 2 or 3 times just this week. Maybe you guys heard the same thing, where the number of people who have $1,000 a month car payments or higher has never been more. Like there's the volume of people who have car payments of $1,000 or higher has never been as many as it is now.
It's all the Lambos that people went and financed.
Oh, certainly not that.
It's all the realtors.
All
the realtors from 2020 that decided to buy new cars.
Based on you saying like, the Fed giving all this money, I felt like, I don't know if you ever watched that movie Dumb and Dumber.
Oh, yeah.
When they counted all that money.
In front of the hotel. Like, here you go. Here you go.
No, but that's exactly what
happened. An IOU. You know what I mean? They drive up in the Lambo.
Oh, that's so funny. I want to hold on to that one.
That's it. So it reminds me of that. They made it look so easy, right? Yeah. Because they were spending it that easy. And that's how the economy was flourishing. How do we base economic indicators? Yeah. How people are spending the money.
Right.
People are spending the money, right? Mr. Dumb and Dumber, or they're just going off making it look all good. Like, how are they? Where do they have all this money, right? That's how it felt back in that day when the government's just giving. It's like, how do they have that? They're just spending like, oh, man. Mm-hmm. So what do we go do?
Print more money.
That's it.
Yeah. Well, it's a prediction, but I do see that this will probably get a little bit worse before it gets better. Mm-hmm. I think that this isn't the end of it. First of all, I think the headline is a little bit gimmicky. I mean, because they don't say in the headline, after a rise of 15 trillion, the market retreats by 2.3. They're 2.3 trillion equity lost in the last 8 months. You're like, okay.
On the coattail of a 13 trillion still standing strong since 2020.
The convenience of history, right?
Yeah. It's also the convenience of just sharing information that's out there, right?
Yeah.
If you really look at the numbers, like Brian mentioned, 8% Arizona, 8% was it Las Vegas?
Phoenix,
and then you're talking about 10%. Saying, like, come on. That's not bad. 2008, 30, 40% we were seeing.
Well, right. And compared to the rise.
It was crazy.
Yeah.
Right? So your 10%, I think that's kind of adjusting to the normalcy of what should have happened in the beginning. Like that's not that bad if you really think about it. The great thing, I still have equity in my property, right? It feels good. I still feel like I'm a winner after all of this.
Yeah. So just so people have for people my age, back in, let's say, the 1990s, early 2000, where were rates at? Where were mortgage rates at?
They were higher. I remember locking fixed loans back in 2005, 2006, like at 7.5%.
Yeah,
so
pretty much.
that was where I started locking 30-year fixed loans back when I first started.
But we were seeing the threes also, but at that time it was very different, Brian, because in those times we had what's called a NAGAM loan, and it started at 1%. Back in those days, Brian, you had to pick over. It was like multiple choice: A, B, C, and D. Right. And so the first one, A, was negative termination. So if your payment was $4,000 and you wanted to send a negative payment, you could have $1,000.
As long as you're paying.
That's correct. So people were buying these $2 million, $3 million homes in these, and their payment was low. Anybody could afford it. Well, at 1%, it was, I can do that.
Money.
Well, hey,
let's. Accessible.
And then D, nobody wanted to go and, highlight D because D was fully amortized.
Yeah.
Well, it was actually fully amortized at 15 years.
Yeah. So you had pay option arm, right?
Negative.
It was negative AM, interest only, 30-year fixed, and 15-year fixed. So every month you got to pick which payment you wanted to make, and then based on your selection, your loan balance would be a reflection of that choice.
Exactly.
So your monthly payment would be a reflection of that choice, as would be the loan balance at the beginning of the next month.
And the great thing about that is you could finance at 100%. You had what's called a piggy bank loan. So it was great, right?
It only works when the market goes up.
90% loan for this, and then a 10% second for that one.
Great, I'll take it. I'll take 3.
But all day long.
I'm sure you've seen The Big Short.
Of course.
Yeah.
We saw he was at a strip club, right? And he owned 3 properties. She's like, I bought 3 or 4 properties. It was just that easy because all they asked back in that day was a heartbeat and a credit score.
Yeah.
You know what I mean?
Yep.
Nowadays, it's not the case. Because of the SAFE Act that was implemented in place, everything has to go based on debt to income ratios, et cetera.
Yeah, I think that decision back there, the DoddFrank Act and all that, I think that has a lot to do with where we're at now with scrutiny of loan files, cleaning up the industry, if you will, quote unquote. I loosely say that term. But I think that is going to help avert some of those same consequences now that we had back then. And we didn't have as many opportunities then we do now. So I want to talk about some of those today too. With all this equity, people have opportunities today that we did not have in 2007, 8, 9, when things were falling apart and the bottom's gone. Every day we're coming to work. Let's go to, first thing you do in the day, implodometer.com. What banks are still open today?
I talk like I know what I'm saying now. I've just been around you guys so long.
I'm glad you remembered. I mean, that's just how our day was. Get your coffee, sit at your desk. Implodometer.com.
Walmo's gone.
Great. Remember, we got 3 loans to move today, 4 loans tomorrow. Anyways,
that one's not going to fund.
So people have equity. What are some things they can do? Automatically, I'm thinking, HELOC. That's a natural thing, especially if they got to refinance in 2020, 2021. They got a low fixed. HELOC's on deck. Yeah, go ahead.
Just because you rose your hand.
Yeah. So, all right. So we know that the Fed is raising rates every time that they go up to the plate, right?
Yep.
So that means that consumer credit and anything that's tied to, the federal fund rate is going to be increasing as the year progresses because as we know, what we've been researching and what we've been listening to from the Fed is that they don't plan on stopping the rise in rates anytime soon, or at least not till things get a little bit more positive. So my question to homeowners, to anybody that carries debt, actually just homeowners, if you're able to wipe off all your debt and at a fixed rate, or you could roll the dice and gamble on your debt and let your interest go up higher and higher each month or every several months, what's going to put you in a better situation? Wiping out all your debt and now having freed up cash flow and wrapping it all under one fixed rate payment for 30 years.
Yeah, that's true.
And then now you have all this cash left over. Maybe your payment went up $500. Yeah. But on top of that,
but it doesn't, because you're offsetting the payments you're making individually.
There you go.
So your out of pocket total is not the same.
But you're saving into the back end with the money that you're freeing up from wiping out all your debt. So my advice is that if you have equity, use it to your advantage right now, because when it's gone, you're still going to have that debt. The rates are going to keep rising, and you're still going to be underwater if you haven't had a strategic plan of how to pay it down.
And the great thing about that, Brian, I'm glad that you bring that up, because a lot of people think they have to refinance their first. Well, there's a line of credit out there, which is a HELOC. It's a home equity line of credit. And it works like a credit card. Simply, you have a line of credit for $100,000, and you only pay based on what you use. So if 1 month you don't need a whole $100,000, you just need $5,000 to do whatever you need to do, then you take that and you pay payments on that. You know what I mean? So there's all these options out there, know, and especially if people are looking, my best suggestion is go and look at your bank. Go to your bank, and ask them if they're doing any lines of credit, or give us a call. So we could analyze that. Either way, a lot of times we could also help supplement our income by leveraging, even if you don't have debt. Well, what does it look like if I just converted my 2-car garage into a 1-bedroom junior ADU, especially here in California, leveraging, the SB9 rule and the SB10. If you guys don't know about that, DM us. We'll send you some information on that.
Definitely.
And again, knowledge is power only when applied. So you got to learn to leverage these things. And we know about this because we're constantly doing that with their current clients. They go in there and then they complete their ADU. Like, oh man, all of a sudden I got $1,500. I got $1,800 more. So those are the things that we can do.
No, you hit a great point, and I feel it's it's that knowledge barrier where people don't know what they're able to do and what they can't do, and they still fall back to like, I don't want to touch my equity because that's bad, right?
Well, kind of tying up something you mentioned earlier again too is that there's still going to be opportunities for buying a house if someone wants to in this market because of the equity someone's willing to give up. They're willing to forego, meaning they're going to sell. So some of these people who are going to be unemployed, and we talked about this in the last show, they may be hidden in the unemployment number because they're actually retiring early, or they're getting a severance pay or some sort of early retirement check out, whatever. Well, if they decide, I was going to retire in Michigan anyways, I'm going to sell my California house in San Diego, well, that's equity they're tapping into at, I'd say, the current market high. But that creates inventory to the market. That might help not flood the market so prices won't decline more, but there's an opportunity for a buyer who might want to get in right now because of that situation.
And that's what we're starting to see a lot that I feel, maybe at the beginning of the year was uncertain, but now these, passing February and going into March, we are starting to see a little bit more demand. And I feel it's because people want to get deals. They're looking for deals and opportunities that are out there. And the people that do have the right approval, the right income, and are able to, spend on that, higher payment, they're going to get a good deal. And then when rates come right back down, they're going to be happy they bought in this market.
Yes.
You guys mark my words.
I heard a story just yesterday about someone, because some of these companies are saying, you got to return to work. They're like, you have to come back to the office physically 3 days a week, 4 days a week, right? In office. Well, I'm hearing about companies that are like, Yelp specifically, was like, you have a return to work policy. Some of these cats already moved to Texas. They don't even live here anymore. So they don't live here. They're getting a call back to work in order to keep their job, and they ain't here. So there's I don't know what hidden gem is in that yet, because if they own property here, they're going to come back to it maybe. But I think that's going to provide a little bit of a chasm in the next couple months as these roll out. Because some of these return to work are like in May or in June or September, and you hear Google saying it. Google's even talking about a split desk strategy. Can you imagine like coming in here and like, okay, on Monday, Wednesday, Friday, your desk is your desk.
Andy's there.
And then on Tuesday and Thursday, it's my desk.
Hey, that's how I feel with Mikey.
So anyways, and then some companies are just cutting days altogether.
Wow.
So
That's just crazy.
And not just companies, but countries we were talking
about. Well, here's the thing, guys. If you need to, leverage your equity line of credit, you're thinking of doing these ones, you must have a job, right?
Yeah.
And so one of the things I'm actually hearing out there right now is that a few countries are trying to implement a 4-day work schedule.
Yeah.
So let's see how that works, because normally, like the way we calculate income of your W-2 is, it's 40 hours times 5, and we do all that stuff. So now it's going to be like 4 days.
Well, is it 410s or is it
better be making the same money?
It's because they're going to increase the wages, right?
Wow, Brian
we haven't seen that happen.
Brian with the econ joke. Wow.
But I saw that article where we're trying. There's a few countries, and I have it here because I thought it was like, hey, a 4-day week. I always tell clients when they call me like, how was your weekend?
Yeah.
And they're like, it's short. Who invented this work 5 days and 2 weeks, 2 days off, right? Like, where's the balance behind that?
Innovation. Somebody thought about it.
Yeah, so I see it. So we got Australia, Iceland, Belgium, Ireland. Hey, good day, mate.
Oh, wow.
We have Spain, Sweden, Canada. I know I get all those wrong. Japan. And like, I'm just glad that we're one of them. We get to say like, we don't, usually we get excited when it's like a President's Day or, one of those special days. So we don't work on a Monday or a Friday, what have you, 3-day weekends. Like, yes.
He got the Japan. He's like, and we're one of them. Like,
Japan, Finland, Germany.
Okay. Wow.
Yeah.
How many are there? There's
15, quite a bit. New Zealand, almost? United Arab Emirates. Emirates. They have no recession. It's all oil there. You know what I mean? Look at Dubai. Just by the way, you guys heard how much they paid in Dubai, right, for the FIFA World Cup?
Trillions. 2.3 trillion to be exact.
They said 120
Trillion.
Billion.
Yes.
Billion.
Yes.
That's crazy.
Yeah, that's the most ever.
It's more than the GDP of like Guatemala.
Well, good guess. I hope that's right.
So what's your guys' take? What do you guys think about that?
Yeah, let us know what you think about the 4-day work week. My guess is that what's going to happen is that people are going to end up doing the same amount of work, but just in less time. Back when email first came out, I remember that. People, we're going to have less work. We're going to have 3-day weeks. It's like, no, everyone just ended up doing more during 5. There's just a quicker way of getting work done. More work gets piled on people. We'll see. It's a great social experiment. I hope it works out.
What do you think, Brian? You like that or?
I mean, what happens if you're self-employed?
You just work 7 days a week. That's different,
Nothing
Brian.
changes for us, right? Nothing changes for us. You still got to show up, bro.
We got 8-day work weeks. Come on, that doesn't apply to us.
Funny story the other day. My mom's coming to visit, and she goes, "Hey, do you have any like leisure books I could read while I'm staying with you? Not business books." I'm like, "What's the difference?" She's like,
"Yeah, no,
okay, there's something wrong with you."
No, 100%. Like my friends make fun of me because all I watch is economical stuff.
Yeah.
When I go talk to my friends, I'm like, "Well, do you guys know what's happening with the Fed fund rate?" Th're like, "What the heck is that?" I'm
Who
like,
is that? Who is that?
Who is that? Why are they doing that?
You never knocked at my door.
Like, Brian, Fuddruckers closed.
Yeah. Hey, you should have gave your mama who moved my cheese a quick. I mean, based on her, she reads 5 minutes.
I want to know what people think. I know we talked about this.
That
Like, what do you
great.
guys think? You're listening to the show. You're watching the show. Like, what do you think about a 4-day work week? Is that a thumbs up, thumbs down? Tell us whether you like that idea, you hate
Let
that
us know in the
idea. Tell
comments.
us why. And we'll see how that plays into this whole home equity conversation. I think we had a good talk today about what opportunities people could take advantage of, what's happening, why is it happening, and also like I'd like to kind of conclude my thought of like this isn't anything to be worried about right now. The sky isn't falling. Like, let's not just dive into the headline. Look at the details, what's behind it, and that's why I appreciate you guys letting me share the facts at the top of this show today. Like, the facts are important. We had 15 trillion rise in equity. We've had a retreat of like 2.3. I'm totally cool with that.
Yeah. Let's look at the cup half full, right?
Yeah.
What would you do if you had $200,000-$300,000 of equity in your home? What would you do with that? Because there's some people that don't. They can't even imagine that. You know what I mean?
Yeah.
So if you are a homeowner, DM us.
Tell us
what would you do with
what
that?
You need. Tell us what you want.
We'd want to know.
We need to know. And also, if you're watching this or listening to this and you need help, like you especially need to raise your hand and ask so we can at least give you some guidance. You can talk to Brian. You can talk to Memo. You can talk to me. I'll tell you to talk to one of them and we'll help you out. So we are also going to talk about another topic. We're going to dedicate a whole show to this, guys, but we're going to talk about reverse mortgage. I think that is like the last thing in this is we have to talk about reverse mortgage as people are aging and they're getting nearer and nearer into their 60s and their retirement age. They're looking to Medicare. They have home equity through the roof.
Income.
And I think the reverse mortgage is going to be the savior and the storyline of 2024 and 2025. So that's my teaser as we go out today. But I'm excited to have the conversation with you guys next time.
That's right. There we go.
So thank you guys again for listening to the Mortgage Heroes Weekly Podcast. We appreciate you all, and we'll see you again next week.
Later, guys. Woo.